Good afternoon, everybody, and welcome to the Real Estate Rundown. I want to welcome you back, and today we've got a special guest who is the star of his own podcast. He's a professional real estate fund manager. He's got about $43 million worth of assets under management. He is a co-founder of Mesos Capital, and he is not only, that's just the beginning of where he started, guys. This guy has a master's degree from Carnegie Mellon University. He's got an engineering background. He's worked in the FinTech industry, but now he's focusing on real estate. Here to talk with us today, guys, is Pancham Gupta. Good morning.
Good morning, Shannon. Thank you for having me on.
You have a really diverse list of things that you've done. I mean, you came from college career background with a master's degree, with going into engineering, and now you're completely over into real estate. Tell us a little bit about that journey.
Absolutely. So even before the college degree, so I am originally from India. I was born and brought up there. I came to the US for my master's degree in computers from Carnegie Mellon. And the idea at the time was that I would get my degree and I would go back home to my home country to do something on my own there. And I just started working here to get some work experience and all that. And, in 2009, we actually sold everything that, we had to go back. And then we found out that, we are expecting our first kid. We said, okay, you know what, let's delay the plans and the history will have it. We never go back. We decide to stay here. And, in 2011, 12, I started, when I decided that not going back, I started reading a lot of books about investing here. And I read this purple book by Robert Kiyosaki, Rich Dad Poor Dad, and Cash Flow Quadrant. It has changed many people's lives. So it did for me as well. And I started investing in real estate as a hobby. Slowly it became addiction for me, and at some point it became passion for me. I had properties in over 5 different states as a side investing thing, and then slowly I started raising capital. Also, people started reaching out to me to invest their capital because they knew what I was doing, and from there on I decided that this is what I want to do full time, and I quit my job and started doing syndications full time. So that's the long and short of it, real quick. But yeah, that was the journey.
You're one of many people that mentioned Robert Kiyosaki, but you're one of few people that are honest enough to tell people that real estate can become an addiction, because it really can. It's something that starts out as a hobby, but then it slowly takes over your life. And then the next thing you know, you're on vacation, you're driving through Hawaii, you say, oh, look at this. I wonder what that house will sell for. And then I wonder what it would rent for. And your wife just wants to go to the beach, but it becomes an addiction. And it's so funny because most people won't admit to it. All of us that are in real estate full-time know that it is an addiction. But I'm glad you pointed that out, and you're not afraid to be honest with my listeners. That's awesome. From what I heard, you've only been doing real estate, even as a hobby, for about 8 years, and you've only been doing it full time for how long?
Full time, little over a year, actually.
When was it that you realized that you could stop doing the daily grind and really do this full time and make this 100% of what you do in real estate?
So that was a slow progression to that decision. But really, at some point, I realized that, why am I doing this daily grind where I have this little thing that I'm so passionate about, and, that I would literally not sleep at nights and look at the deals and all that. So in 2017, I really realized that, what, even though I have a very high paying, lucrative career in FinTech, this is something that I want to make as my full-time passion, pursue my passion full-time gig. So it was really a decision. There was nothing really that I had to go through, physically. It was more mentally, and it was very hard decision for me. My parents, my wife, everyone actually was against it for me to quit my full-time job, which was actually very, very lucrative.
We all get comfortable with the security, right, that a job is. I mean, that your wife knows that on the 1st and the 15th, there is money in the bank account.
Yeah.
And the real estate, well, that's kind of his hobby, you know. And so maybe we're going to buy another property, and then all the money goes away again because that's what he used to buy the property, right?
Yeah.
My wife does the same thing. She says, "Do we have any money, or are you buying another property?" And I just have to tell her, I said, it's all going to pay off someday. And she said, yes, but the electric company called and they want paid today. So, so you are doing syndications with your multifamily. Tell us more about that and what you've got going on.
It's me and my partner, two of us. Before I quit my job, we've done like 5 syndications, and that's what me and my partner started doing back in 2017, where we pooled together a bunch of resources, in this case money from friends, family, different people, to go buy multifamily buildings um, and give out nice returns in return for this invested capital, and also make the community better for the tenants, and overall win-win situation for everyone who's involved in the project. So far we've done 5 syndications, and we are in the process of creating a brand new fund, because we believe, given that we are in this COVID-19 situation where in 6 months to a year we are going to have a lot of good opportunities available for us to invest our capital and generate some good returns for the investors.
So, a lot of people are saying that we're going to have, the COVID slowdown. We're going to have, the COVID crush. We're going to have, the foreclosures, the forbearances are going to hit. What particularly makes you believe that the economy is going to suffer because of COVID, and when do you think that's going to happen?
Yes, so that's again a very, very good question, $1 million question. I'll give you my opinion on that. So there is this, this guy Beckminster Fuller. He had this theory on, whenever you throw a rock in the puddle, like, so there's a ripple effect, right? There's a smaller ripple, then bigger, and this bigger ripple. So right now, like, I have a lot of friends who own businesses, like whether it's restaurants or gym owners or spa owners, and different kinds of small businesses that are out there. Even though stock market is going up and up and up, and the Federal Reserve is printing a lot of money to sustain all of this, what I'm seeing on the ground is that there are a lot of people who are actually hurting, who have small businesses. Yeah, they're okay right now because they got some relief from the different kinds of loans that were given out. But when this all goes away, I believe that we will start to see it will start to happen at a level of small businesses, and slowly those people who own those businesses will be in trouble, or the employees who are working there will be in trouble, and it will be a ripple effect, like smaller circle becoming a bigger circle and all that. And in again, it's very hard to predict when will this happen, but my guess is that if this thing were to stop after, I believe election could be the key point there, where the stimulus runs out, or if what we don't know what will happen there, but in 12 months to 18 months, really, we will start seeing some kind of impact, assuming that this money runs out, or people who are hurting right now will not have any relief later on.
I just pulled that up because I had a quick question about what you were talking about as far as small business. And small businesses actually make up 64% of the new jobs created in the United States in 2019. So really, if what you're saying happens, that small businesses go away, or some of them die, some of them get closed, some of the people that were going to open their business this year that aren't going to open it, you're looking at a lot of new jobs that aren't going to be created. Without jobs, you have unemployment go higher. With unemployment going higher, you have less funds in your household to rent, to get your properties, to pay for your food and clothes and all that kind of stuff. So it really does change a lot. And I think a lot of people forget that small business is the largest employment driver in the U.S. It's not big
Absolutely.
business. And so when small business gets hit, everybody's talking about the airlines are getting hit, and Marriott's getting hit, and the Hilton's suffering. But you're right, the gym owner and the restaurant owner and those guys are really getting hurt. When that happens, that's going to create quite a bit of opportunity, because there's going to be a lot of constriction of the cash in the economy, which those operators that weren't leveraged properly or were leveraged too far are going to be struggling. There's going to be a lot of people that, don't you agree, that were getting ready to sell, that are going to say, well, let's go ahead and sell before the price goes down any farther. So I see, for several reasons, we're going to see a lot of a shift in the market. I think you're right. There will be a shift. Now, I'm not going to say that it's going to be a recession, but I do think that you're going to see some pricing changes. I definitely do. Do you think that banking is going to play a part of that, with the difference in the reserves that they're requiring and some of the other things that you might see?
Yeah, you mean in terms of the funding of the things? Yeah, they are definitely there. We are already seeing those changes in the debt markets, where the banks have gotten really strict on their lending criteria. We are actually in the middle of, I'll give you a very quick example. We're in the middle of refinance of one of our buildings, and they increased the debt service coverage ratio, which is really how much money you have left over, after you pay out the debt. They have increased that ratio, and then on top of that, they've also asked us to put in 12 months of principal and interest in the escrow, which is subject to certain conditions to be released. So what that really does is that you now need to bring in more capital to actually close some of these deals. And so that goes back to the same thing, like how many of these deals will actually work out if you have very few banks, number one, lending, and then on top of that you have very strict criteria on the debt terms.
And so then, for those of you that are following along with your calculators, you'll see that as you have to add another 12 months worth of interest and reserves, it means that you're bringing more cash to the deal, which means that your return has to be dispersed by more people, which is going to drive down your returns. As
Exactly.
we all know, without certain returns, we're not going to do the deal, which then puts the pressure back on the seller to adjust the purchase price. And that's
Exactly.
where we're going to see, I agree with you, that we're going to see the biggest push back is in the finance area, where we've got to bring cash to the deal. I think that the stock market is going to help us bring more capital out of the stock market into real estate, because it's getting crazy out there. And
It's
I
getting
think
crazy. Seriously, it says that it's like the fundamentals are completely defied right now. These things are trading, and you can understand they're printing so much money, and this capital has to go somewhere. You're not really getting much in the bank. So what does this capital do? It needs to find some place, and most of it is going in the stock market. And especially after the vaccine is if the vaccine comes out, and it's positive, we believe this capital will find even more, will try to find home for it, right?
Well, and I mean, it reminds all of us that have been around for a while what it was like with the .com bubble, or I mean, all of those kinds of things where we just saw, why are you investing in that? Because it's going up. Why? I really admire what Elon Musk has done with Tesla, but I don't agree with the price of the stock right now, because it's crazy.
Exactly. And Shannon, you have been around for all multiple of these recessions, right?
Yeah.
And you can even, your experience, I'm sure it's always something.
Yeah.
And the end result is the same, right?
Yeah. The only thing higher than Tesla's stock price is that first rocket they shot off to Mars, right? I mean, it doesn't make any sense. And so then we come back to the fundamentals of what we do, what you and I do in real estate, where it doesn't matter what the markets do, people still need housing. They still
Exactly.
need the ability to shelter, and that will always be there. So when you are looking, when you look at your properties and what you have in your portfolio, do you have Class B, Class A, Class C? Which ones do you have?
So we have a mixture of Class B and Class C products in our portfolio. So I would say about 50-50.
And where do you think the value is going to be going into the market that we're going into? Is it going to be in the Class C's or is it going to be in the B's?
So that's a very good question. I'll tell you, my personal opinion is Class B, like B minus, so to speak, B minus. And what we are seeing even now, like our delinquency, which is the number of people who are not paying, like the rent that they were supposed to pay, is slightly higher in C's than in B's. For whatever reason, and also right now what we have seen, and I'm sure you would have seen that in your markets too, but the spread between the pricing per unit of Class C product and Class B product has reduced over time. And so you could buy Class C product, like Class B product, with not a lot of premium on top of what you would pay if it was a Class C product. So what we like, our personal philosophy is that we believe that Class B product or Class B minus is going to is a better, value for money right now. And when, as the time goes on, we believe Class C, just like a small cap stocks versus big cap, Class C product will fall a lot more in value as compared to Class B. And yes, then there will be opportunities in Class C.
And it's funny because, as like with all markets, and I will be the first to admit that the real estate market is hot also, right? I mean,
Yeah,
3%
exactly.
interest rates will heat up any market, right? I mean,
Yeah,
it. But when you really think about what you're saying as far as Class C, everybody looks at it and goes, well, if I get in at the bottom and I buy this one that needs a lot of work, then I can make my Class C a C plus or maybe a B minus. So I will buy this one and hope and push and do more. And then what's probably happening is a lot of the operators that have done that, and they're on their fifth or sixth year of doing the Class C's, are now moving to the Class B's, where they can go, nah, I don't want to do so much work. I want to know that there's some solid value in there, that I'm not fighting against falling into the lower echelon of the market. And so there's been that pressure, you're right, to bring it
exactly.
there to where, you can buy them for this much, but just for a little bit more, you can get to Class B. What do you think is going to happen with Class A as we go into the market that we're headed into?
That remains to be seen. I think location will play a very key role there in terms of Class A. All the jobs, we have people who making good salaries in Class A product, and the kind of tenant base that's there is someone who really cares about, you know, uh, paying on time and paying, and having jobs, worry about their credit scores and keeping the place nice and clean and all that. So I would say that it would be very location specific, in my opinion. Like all these areas which have diversification of jobs and have high paying jobs. For example, we are very focused in Raleigh market, I believe, which is a tech hub in North Carolina, right? Like on the east side, we believe that that market is not going to have a lot of impact as far as the Class A product. But then we have some of the buildings which are way in the outskirts, right? Like in the MSAs where there's not a lot of high-paying jobs. And if you have a Class A product there, that is going to suffer quite a bit.
There's, again, it's just like the Class B and the Class C, right? People, they get out a little bit farther and they say, well, this is a better deal because, the price there, but, it's also farther away. And so when people are looking at it and going, well, you know, Rarely do people look at it and say, well, I'm losing my job, I'm going to move farther away. You know, people look at it and they try and stay where they're at. They might come out of an A class and go to a B class, but they tend to stay where they're at. If they're a commuting person, they're going to commute anyway. And what I'm seeing, because, you know, we're in Boise, Idaho, and Boise, Idaho has an MSA of about 700,000 people. But we are seeing people move from the left coast, left and right. I mean, we're seeing them come in all the time. And we're seeing more now than before COVID. We're seeing more people move during COVID than before, because people are looking at it going, you know what? If I'm going to be locked somewhere, I'm going to be locked where I can look at the mountains, where I can, you know, where my neighbor is not 6 feet above me or 8 feet below me and right beside me. I have a house, you know. Things are still fairly affordable where we're at. And then when you have companies like Twitter and Facebook that say you don't have to come back in the office ever, then all of a sudden people go, well, I can keep my job and I can now do what I need to do from another place. And so we're seeing a lot of people move into Idaho. Texas is seeing the same kind of thing. Phoenix is seeing the same kind of thing. And so while I agree with you on the Raleigh and the outside areas, I completely think it does matter on location, because we are the outside area. Yeah. And we're getting everybody moving to us because of how they work, not where they work.
Exactly. I think you're absolutely right. So that's what that location has to be in demand, like Boise or Texas, and some of the locations you mentioned, right, where people do want to go, like Phoenix, for example, and kind of work from there. So those locations are going to be in hot demand, like, you know, where people, they would like to live where they want to live and then work at Facebook, let's say, from those locations.
Yeah. Where are you looking at for your next deal? What is your sweet spot?
So our sweet spot is, in terms of, you know, like, we are looking at 6 markets mainly in the Southeast, and there are 3 in Florida and 2 in North Carolina, Raleigh and Charlotte, and 1 in Atlanta, like Georgia, which is Atlanta. So these are the 6 markets that we are looking at, and our sweet spot is, like we were discussing, Class B product, and between, you know, 10 to 20 million dollars worth of deal, and, you know, built right after 1985. Anything after 1985, we are not looking at anything that was built before 1985. So that's where we are. I mean, we have a long checklist of criteria, you know, that we are looking at. But that's our sweet spot. Like, the average rents have to be at least $700, and the median household income has to be at least $40,000, and things like that.
And I would imagine with an engineering degree, you have quite the checklist of criteria.
We have actually a long checklist, and we actually send that to all the brokers, and so that way it helps us with the deal flow. Like, you know, we only get things that we really want, but if it does fit that criteria, then we can get pretty aggressive.
Yeah. Well, and, you know, I want to point out again, Pancham, how bad your addiction has gotten, because you've only been doing this full time for a little over a year, and you said between 10 and 20 million dollars, like you are Warren Buffett, like you you deal with 10 and 20 million dollars all the time, because you've been looking, and you've done the deals you've done very successfully, and you've gotten comfortable. And my congratulations to you on being able to take this from a hobby to a full-time job, to replace what you were making, but become comfortable in your new profession, because this doesn't have anything to do with engineering. This is not like engineering at all. It's not like you went from computer engineering to civil engineering, where you still have provable theories and all the things that go in and out of engineers' minds, you know. But this is very, very different. This is a very fluid experience. How has that been for you, coming from the rigidity of engineering to the fluid market movement, tenant movement, pricing, financing, all the things that are fluid in a real estate deal? How has that been a change for you?
So, you know, engineers, they are known for this analysis, paralysis by analysis, right? So you're right. It's very, very different from engineering. But I'll tell you that, I was in finance for 14 years, engineering, fintech industry. So the engineering actually has helped me to create processes in this business, where I feel that there is lot to be desired to improve the processes, and get to a point where you have a streamlined process, like just the way in engineering. So for me to adapt to this new world, the moving world, right after I quit my job, imagine COVID happened. Who would have imagined that this COVID situation will happen? But again, it all comes down to the mindset, and I believe that whether you have any kind of degree, whatever you're passionate about, you would find way to actually make yourself comfortable, and get to a point where you enjoy it so much that you kind of block out all the negativity or negative thoughts that you have. So
You mentioned that too, and I can only imagine the order that an engineering mind would bring to the chaos of real estate. you know and I know that for me, as a developer and a builder, general contractor, I look at putting the subcontractors there to do the organization, right? I mean,
right.
I don't look at putting all the plumbing pipes together. I look at the plumber to do that, so he brings the order. I just bring the people. Whereas an engineer, they have to bring the process, and they have to have the standard operating procedure for this. But I would love to be a part of a deal like that, because it would make me feel very comfortable that everything has been thought of. Everything is on paper, everything is written down, everything is double checked, and that would be very different than a lot of developers in how they do things, myself included, because a lot of what I know is from 25 years in the market. A lot of what I get right here is the same as what you get right here, but it's this that's been happening for 25 years, and we bought that, and this proved to be right, and we bought that, and then this proved to be right, and now we have it in our gut.
Right.
But to have the checklist, and we're very much in the process of doing that. I have a gentleman who is bringing everything under one roof and standardizing all of our operating procedures and getting our due diligence checklists all standardized, because we have a different one for industrial, we have a different one for multifamily, and getting it all the same. And so you would love that. Here in 6 months, when all my checklists are the same, I will show you, and then you'll look
No.
at that and go, well, that's a great start. But
Yeah, no, actually, this is great. And I'll tell you what you just mentioned. You mentioned one very, very key principle for any business, not just real estate, which is people, right? Like, you have right people for the right job. And that reminds me of a quote from Henry Ford. And once he was questioned, right, that
yeah.
how come you know everything? And they all got together, and he just picked up the phone and got the right person. He's like,
Yeah.
I do the most important thing, which is think.
Right. Yeah. And, Henry Ford, I quote him all the time, because he's known to have said, I don't know the answer to that, but I have someone that does.
Exactly.
My other favorite saying is stay in your swim lane, right? It's not famous, but it's what I say all the time. And I find sometimes that the people that work with me, they tell me, that's not your swim lane. You're over here in my side of the pond, and you're dog paddling where you shouldn't be, Shannon. Get out of here. And it's true. And you're so right, because the people make the deals.
Exactly.
The people that you're working with, the people that you're employing, the people that you're contracting with, the people that are the brokers that you're working with, everybody in the deal, and how you treat them and how they work together is so important in real estate, because it has to make that engine continue to go around and to get where it's going to go. So now you mentioned earlier that you were creating a real estate fund.
Yeah.
Explain to us what the difference is between a real estate fund and a syndication, as we all know syndications.
Sure. So in a real estate fund, like in a syndication, you are actually doing a single deal syndication. You're actually buying a deal, and you're raising capital for that deal, and the fund raise is complete, and the fund is like the individual syndication is closed as soon as that deal is done. So it is very, very specific to that one deal. People come in, they know exactly what they're investing in, and they invest in that deal, and it's done. There's no more investors coming in for any other deal. But in a fund, what happens is that instead of having one deal, you have objectives that you want to stick to. So for example, if you're creating a fund, you will say, okay, we are going to look at 100 plus unit deals. It will be built between this and this, and there will be a bunch of objectives that you want trying to hit, and people will be investing in that fund based on those objectives. And then you will go out as a fund manager to buy deals which fit that criteria. So it could be deal 1, deal 2, deal 3, all under that one fund. And then people as investors, they will get benefits of diversification among those different kinds of asset types or different locations or all that stuff. But and also they don't have to know the deal, so they are trusting you as a sponsor or the jockey of the horse to pick the right one for them, and then you go out and do the deal. So that's the difference between fund and doing a individual syndications. It's similar to, like, for example, investing in a REIT. This is a level below the REIT. REITs are traded on a public exchange, but at the end of the day, REITs have objectives, and you actually go invest in a REIT. You don't know which deal you have actually invested in. It is the fund manager who is making that decision for you.
So why, Pancham, why are you taking it from a single specific deal to a fund? What is the advantage for you? What is the advantage for your investors?
So I'll tell you why we are doing it. Number one, right? For us, the majority of, like, major reason is that we believe right now that a lot of capital is waiting on the sidelines and looking for the deals. And we also believe in some of the markets that we are in, that we are going to get these opportunities, and we are also looking at development. And so what we want to do is we want to kind of get the money side of the equation out of the way and be ready when a deal comes to actually go and grab those things. So we've been talking to multiple brokers, and some of these deals are going to come and go so quickly that people who are not ready or who don't have the capital, they won't get the opportunity to actually go and even get those deals. So that's one of the biggest reasons why we are doing this. And second is we are trying to look at different opportunities. So we are doing grounds up development here in the tri-state area, and then also looking at these existing multifamily deals in the southeast. So we want to give that opportunity to our investors who want to be part of both, and they don't want to, like, have to pick and choose between either one of them when they have certain capital. So we have had our investors who have come to us and they said, you know what, is there a way where they can be part of multiple deals with this capital? And so that's the other reason and for us to do this.
Yeah, well, and especially where you guys have the track record. You said you've completed, you've gone all the way through the cycle with 2 of your syndications, and you have that track record, and you have investors that have invested with you before and they're comfortable. It would be an easy situation to say, hey, we can create the fund and now we can go track down some of these other deals. Because as you know, with every real estate deal, there's 2 ways to buy it. One is price and one is terms.
Yeah.
The quicker you can come to the table with the money and the proof that you have the money, the more real the seller is going to feel. And especially for a distressed seller, they will be very interested in a very quick closing, more interested in that than they will be in the ultimate price, I think, because of what the property, the pain point that the property is bringing to them is what they're trying to eliminate. They're not trying to necessarily, if they're losing the property, they're not trying to recapture dollars. They're trying to stop bleeding. And so exactly. I think that that's a very wise thing. So you have in a very short period of time come from a part-time hobby, as you said, to realizing this was your passion, to moving away from a very good job And has your wife forgiven you yet?
What's that?
Has your wife forgiven you yet for quitting your good job?
Yes, she has.
You know, my wife would be very concerned if I was going to be working from home all the time. I don't know that she would like that. But now you are going to the next step that's even a little bit bigger than syndication itself, to a fund. That's pretty ambitious. That's very ambitious. But I commend you because you seem to have all the steps and all the pieces in place to make that very successful. So, Pancham, last question is, where can everybody find you and learn more about your podcast, the deals you got going, how to become involved with you? How can they find you?
Sure. So the name of the podcast is The Gold Collar Investor. I have this podcast where I teach about personal finance. We don't talk about just real estate, but generally, different asset classes, asset protection, life insurance, things like that. So they can find out about that on the website, thegoldcollarinvestor.com. And they can reach me at my email, which is p@thegoldcollarinvestor.com. And there is a investor club I have there. If they want any information, they can always reach out and even find me on LinkedIn.
So if you've been watching this, you can look right over his head. There's the Gold Collar Investor right on the wall. Right there. Exactly. You nailed it. And then p@goldcollarinvestor.com.
p@thegoldcollarinvestor.com.
Thegoldcollarinvestor.com. All right. So, Pancham, I really appreciate your time, and I really appreciate you stopping by the Real Estate Rundown and giving us some insight into what you've been doing. You've been a very busy guy. We can't wait to see what you're going to do in the next coming years with your new fund and how that's going to propel you. I hope that there are deals for you to find that don't cause a major recession, but I hope you all the success in the world, my friend. Thank you so much for coming by the Real Estate Rundown.
No, thank you so much for having me, Shannon.
All right. Everybody, it's been Pancham Gupta with the Real Estate Rundown. I'm Shannon Robnett. We will catch you next time. Be good and be safe.